Breaking news! What if I told you that you can spot the directions of the market based on one thing, the volatility index? I use the volatility index futures market, one that measures the fear and the greed of the SP 500, to put on a monster trade today and make $6,137 of profits. And I'm using this example to teach you a lesson about how to get that final piece of confirmation to get into a trade that yield the highest probability of success. Don't forget to click that like and subscribe button for more trading education such as this one. Let's get right into it. The VIX, or the CBOE Volatility Index, is a measurement expected volatility in the stock market over the next 30 days. It used the option calls and puts of SPX, an index of an SP 500, to best predict the expected price of the market. It's often referred to as the fear index because it tends to increase when there is uncertainty of fear in the market. Traders and investors use the VIX as a gauge of market sentiment as well as hedging tool for their portfolios. So when the VIX is high, it typically indicates that there is a high level of market uncertainty and risk. For me, I use the VIX as the opposite directional indicator to the market that I'm trading with. In a way, the higher the VIX, the lower of the E-mini SP 500 index futures, and vice versa. The lower the VIX, the higher of the E-mini SP 500. I'm talking about the complete opposite relationship between the fear index and the overall market. So in this particular trade example, notice how the volatility index futures has been bouncing up and down in a range. In the technical terms, we call this support and resistance. The true concept to take this trade really is to wait for the resistance of the fear index, or the VIX, to break it to the upside in order to trade the market to the downside. The overall market should be at support, but when the fear index breaks the resistance, the overall market could be in trouble. Let me highlight this relationship as it is the key ingredients for my success today.
When you perform a pre-market analysis based on multiple time frame, keep them at the same time frame like this. You're going to want to perform a side-by-side comparison. On the left-hand side, you want to have the overall market, the SP 500 futures. And on the right-hand side, you want to have the appearance of the VIX future with the most current contract expiration day. Apply the opposite directions relationship. It's easy to spot. The higher the volatility index, the lower the market. So as a trader, if you don't know where the directions of the market is going, just analyze the volatility index. When the fear is on the rise, sell-off is going to happen. I took a major advantage of this opportunity here. When the VIX broke $20.05, this is the exact same chart that I showed earlier, it's just on a smaller time frame. When this $20.05 break to the upside, I made a trade of the overall market to the downside, just right underneath this yellow line right here. Very clear and simple. You don't need any fancy indicators. You just need to look at the price actions onto two complete opposite markets.
Now, for full disclosure, let's bring in the profit and loss screen, show the charts showing exactly what my trade entry was. Then when the bear flag broke it to the downside, I took the trade. I exit some of the positions there, exit some of the profits here, and exit completely out of my positions there. Dollar cross averaging out of the position. In summary, this $6,137.50 trade is not a coincidence. It's a plan, setup, risk management process followed to the T. That's what I call trading. Do this every day and you don't need to work the 9 to 5 ever again in your life. Learn this trick once, financial freedom for life. I'll see you in the next video.